January 30th, 2026. Gold just crashed 7% in a single day. But here's what the financial media isn't telling you. Even after that crash, gold is still up over 66% from last year, the best annual gain since 1979. While your 401k struggled, while the stock market wobbled, while the dollar weakened, gold set 53 new all-time highs in 2025. 53 records in 1 year. And here's the part that should terrify you. The crash wasn't because the fundamentals changed. It was profit-taking after gold hit $5,608 per ounce. Read that again. $5,608 for 1 ounce of gold. But this video isn't about gold's price. It's about why central banks around the world are buying gold at the fastest pace since the 1990s. Why Poland just announced they're targeting 30% of their entire national reserves in gold. Why China, despite slowing purchases at these elevated prices, has been accumulating for years. And why the signals we're seeing right now mirror every major currency crisis in modern history. By the end of this video, you'll understand the 3 data points that prove we're not in a normal market anymore, and why what happened to gold in 2025 is just the beginning. Let's break down exactly what's happening, because the math is absolutely brutal. Let me give you the numbers that Wall Street doesn't want you to focus on. Number 1, gold crushed every major asset class in 2025. Gold, plus 166%. Silver, plus 142%. Yes, you read that right. S&P 500, positive but nowhere near gold's gains. Bonds, still struggling with rate uncertainty. Real estate, mixed performance with affordability crisis. But here's what's wild. Gold didn't just beat other assets, it rewrote the record books. According to the World Gold Council's latest data released just days ago, total global gold demand in 2025 exceeded 5,000 tons for the first time in recorded history. Not 4,900 tons. Not approaching 5,000. Exceeded 5,000 tons. The total value of that demand, $555 billion. That's billion with a B, a 45% increase year over year. Number 2, the price action was unprecedented. The LBMA gold price set 53 new all-time highs during 2025. Let that sink in. In a single year, gold broke its own record 53 times. The average price in Q4 2025 was $435 per ounce. That's 55% higher than Q4 2024. The average annual price for 2025 was $3,431 per ounce, a 44% increase year over year. Then in early January 2026, gold touched $5,608. Think about that trajectory, from around $2,600 at the start of 2025 to over $5,600 12 months later. That's not a bull market. That's a parabolic move. Number 3, the demand structure tells you everything. Here's where it gets interesting. Investment demand dominated 2025. Gold ETFs added 801 tons globally. That's the second strongest year on record. But more importantly, U.S. gold ETF holdings hit an all-time record of 2,019 tons. That's $280 billion in assets under management in the U.S. alone. Bar and coin demand hit a 12-year high. Retail investors, high net worth individuals, ordinary Americans buying physical gold reached levels we haven't seen since 2013. Dealers are describing the environment as COVID-esque. Overwhelming order volumes, supply stress, processing delays at major dealers. And here's the kicker. Instead of discouraging buyers, the delays are making people more urgent to buy. One major dealer reported they're adding new customers at rates they've never seen before. Younger customers. People who never considered gold before 2025. Even Costco is selling gold bars and they can't keep them in stock. That's not normal market behavior. That's panic buying disguised as prudent investing. Number 4, central banks went absolutely insane. Central bank gold purchases in 2025 totaled 863 tons. Now that's actually down from the 1,000 plus tons per year we saw in 2022, 2023, and 2024. But here's why that's misleading. At $2,000 per ounce, buying 1,000 tons costs you about $64 billion. At $4,000 per ounce, buying 500 tons costs you the same amount. Central banks didn't slow down their spending. They bought fewer tons because the price doubled. The dollar value of their purchases remained massive. And in Q4 2025, central bank buying actually accelerated to 230 tons, a 6% increase quarter over quarter, despite record high prices. Who's buying? The National Bank of Poland added 102 tons in 2025. They're now at 550 tons total, representing 28% of their total reserves. And their governor just announced they're not stopping. Target, 30% of reserves in gold, with an ultimate goal of 700 tons. Poland's governor literally said, "Gold is the only safe investment for state reserves." Kazakhstan added 57 tons, their highest level of annual buying on record. Brazil re-entered the market after years away, adding 43 tons in just 3 months. The State Oil Fund of Azerbaijan bought 38 tons. And China? The People's Bank of China has been accumulating for years. While they slowed purchases in 2025 at these elevated prices, they've been building reserves consistently since 2022. This isn't speculation. This is documented buying from official sources and the International Monetary Fund. So why is this happening? The mainstream media will tell you it's geopolitical uncertainty or inflation hedging. That's partially true, but it's missing the deeper structural changes that are driving this. Let me give you the 3 real drivers. Driver 1, the systematic destruction of the US dollar's reserve status. According to IMF data, global central bank gold holdings now account for almost 20% of official reserves, up from around 15% at the end of 2023. Gold has now overtaken the euro as the second largest reserve asset globally. Only the US dollar holds a higher percentage of central bank reserves. Driver 2, the US debt spiral has entered the terminal phase. As of September 2025, total US federal debt hit $37.4 trillion. That's 120% of GDP. Federal debt held by the public, $30.1 trillion. That's 99% of GDP. Let me repeat that. U.S. public debt is now equal to 99% of the entire U.S. economy. Interest payments on the debt now exceed defense spending. In fiscal year 2025, the U.S. government spent $970 billion on interest alone. That's 3.2% of GDP and 14% of all federal outlays. The government is borrowing money just to pay interest on money it already borrowed. That's not a sustainable fiscal position. That's a debt spiral, converting dollars into gold. Driver 3. The institutional shift from gold as commodity to gold as currency. Randy Smallwood, the CEO of Wheaton Precious Metals, said it perfectly at a recent conference. For the last 40 years, we've thought of gold as a commodity. We forgot that it's a currency, and it is a currency. That's the shift happening right now. Institutional investors, pension funds, sovereign wealth funds are no longer treating gold as a speculative commodity trade. They're treating it as a monetary asset, a form of money. JP Morgan's global research team projects gold will hit $5,000 per ounce by Q4 2026. Goldman Sachs sees $5,400 by end of 2026. Union Bancaire Privé forecasts $5,200. But here's what matters more than price targets. The analysts are all saying the same thing. Central bank and investor demand for gold is set to remain strong. JP Morgan forecasts 585 tons per quarter of combined investor and central bank demand in 2026. That's elevated by historical standards, and it assumes central bank buying of around 755 tons for the full year 2026. Now let's bring this back to what it means for Americans specifically. The inflation reality check. The official CPI number for 2025 averaged around 3% depending on the month. But anyone buying groceries, paying rent, or filling up their gas tank knows that number is fiction. Real inflation, what you actually experience, is running far higher, and it's accelerating. Why? 2 reasons. First, the money supply increased 40% since 2020. M2 money supply went from around $15 trillion to over $21 trillion. You can't inject $6 trillion into the economy without consequences. Second, we're seeing the early stages of deglobalization and supply chain fragmentation. Tariffs are increasing costs. According to the Bipartisan Policy Center, customs duties increased 89% in the first half of fiscal year 2025 due to increased tariffs on imported goods. Higher tariffs mean higher prices for consumers, period. The Federal Reserve cut interest rates 3 times in 2025, reducing the federal funds rate from 4.75% at the start of the year to 3.5 to 3.75% by December. Lower rates make dollars less attractive to hold. And here's the critical point. The Fed is trapped. If they keep rates low, inflation accelerates and the dollar weakens further. If they raise rates, the interest burden on $37 trillion in debt becomes catastrophic. They have no good options, only bad options and worse options. The wealth transfer that's already happening. Let me show you what's happening in real time to American wealth. A person who held $100 in cash on January 1st, 2025 has lost approximately $3,000, $4,000 in real purchasing power due to inflation. Their nominal balance is still $100,000, but their real purchasing power declined. Meanwhile, the average American has the majority of their retirement savings in a 401k invested in stocks and bonds. Stocks that are trading at valuations 40% above historical averages. Bonds yielding 3 to 4% while real inflation runs 6% plus. That's not a retirement plan. That's a wealth destruction mechanism. The mistake most Americans are making right now. The biggest mistake I'm seeing is inaction due to analysis paralysis. People are waiting for the right time to buy gold. They're waiting for a correction. They're waiting for more data. Meanwhile, central banks are buying. Institutions are buying. Retail demand is at 12-year highs. You don't need to predict the exact top or bottom. You need to acknowledge the structural trend and position accordingly. A 10-20% allocation to gold will not make you rich overnight, but it could be the difference between preserving your wealth and watching it erode through currency debasement. Let me bring this back to where we started. Gold just had its best year since 1979, 66% gains, 53 new all-time highs, over 5,000 tons of demand for the first time in recorded history. This wasn't driven by retail speculation. It was driven by central banks converting dollars into gold, by institutional investors recognizing that we're not in a normal monetary environment anymore. The U.S. has $37.4 trillion in debt. Interest payments exceed defense spending. The Federal Reserve is buying treasuries again after pretending they stopped QE. The dollar had its worst year since 2017. And the response from central banks around the world? Buy more gold. Poland says gold is the only safe investment for state reserves. China has been accumulating for years. Kazakhstan is buying at record levels. Brazil re-entered the market after years away. They see what's coming. The question is whether you do. This is not about predicting the exact price of gold next month or next year. This is about recognizing that the 75-year monetary experiment with pure fiat currency is showing severe stress fractures. When central banks don't trust other central banks' currencies, they buy gold. When countries repatriate gold reserves from London and New York, they're preparing for a world where trust in the dollar is diminished. When demand hits 5,000 tons in a single year, you're witnessing a fundamental shift. The mainstream financial media will tell you gold is just experiencing a normal rally, that it will correct and everything will go back to normal. But the math says otherwise. The debt says otherwise. The central bank buying says otherwise. You have a choice. You can wait for perfect information. You can wait for the consensus to confirm the trend. You can wait until gold hits $7,000 or $10,000 and the media finally admits the dollar's in trouble. Or you can position now. A reasonable allocation, dollar cost averaged in, physical and paper, insurance, not speculation. If this analysis gave you a new perspective on what's actually happening in the gold market, hit that subscribe button. This channel is about data-driven analysis, not financial fantasy. We break down the real numbers so you can make informed decisions. Drop a gold bar emoji in the comments if you're taking action on this, and tell me what percentage of your portfolio you're allocating to gold. I read every comment. The ultra-wealthy figured this out years ago. Bill Gates owns farmland and hard assets. University endowments hold gold. Sovereign wealth funds are diversifying out of pure dollar exposure. The only question is whether you'll do the same before it's too late, or whether you'll be holding dollars wondering why your purchasing power keeps declining while gold owners preserve their wealth. The data is there, the trend is clear, the window is open. What you do with that information is up to you.